You are listening to Talk Tickers. We cut through the noise to find the signal for the experienced investor.
And today the signal is, well, it's a little confusing.
It really is. We're doing a deep dive into Regeneron Pharmaceuticals, ticker REGN. The date is February 2nd, 2026, and their Q4 earnings call has given us a lot to chew on.
It's given us a textbook, almost a clinical example of a beaten retreat.
That's the perfect term for it. You look at the headlines and everything's green. Revenue beat expectations. EPS beat expectations.
And yet, the stock closed down about 1.1%, around $741.
So that's our mission today. We need to unpack that disconnect. Why is Wall Street looking at what seems like a great quarter and just shrugging?
I think it really comes down to this tension between what's happening now versus what they're planning for the future. I mean, the commercial engine is running hot today.
You look out.
But when you dig into the guidance, into that expense line, you see a company planning to spend a staggering amount of money.
And investors are looking at that bill and getting a little nervous.
They're asking if the price tag for all this innovation is getting just a little too high.
Okay, so before we get to that spending spree, let's just lay out the numbers. You said it was a beat. How convincing was it, really?
Oh, it was operational. This wasn't some kind of financial engineering. Adjusted EPS came in at $11.44.
And the street was looking for what?
Consensus was $10.62. So, a pretty healthy 82-cent beat on the bottom line.
Okay, and top line?
Revenue hit $3.88 billion. That was about $80 million ahead of what people were expecting. Total revenue up 3% year over year.
So the machine is definitely humming.
Yeah.
But the stock action, it opened higher, looks good for a minute.
And then just faded all day long, closed in the red.
And you said the culprit was the expense guidance for 2026.
Absolutely. R&D spend, they're projecting it between $5.9 and $6.1 billion.
$6 billion.
Yep.
And that's just on research. We're not talking about building factories. That's pure science.
Pure science. Then you stack another, $2.5 billion on top for SG&A expenses, and that pressure on the operating margin becomes really obvious.
But they have the money, right? The balance sheet is a fortress.
It is. They ended the year with over $16 billion in net cash and securities. Some people think their total liquidity is closer to $19 billion. They have the money.
So they're just telling the market, we're spending it.
They're explicitly saying, we are not hoarding this. We are not just giving it back to you. We're going to go run experiments.
Now, we know how much Wall Street loves seeing potential buybacks turn into petri dishes. So let's talk about where that cash is coming from. The engine room. We have to start with the juggernaut, Dupixent.
The growth flywheel. It is really hard to overstate how dominant this drug is.
The numbers are just wild.
Global net sales were $4.9 billion in the fourth quarter alone. For the full year, fiscal 25, that's almost $18 billion.
$18 billion is practically its own economy.
And it's up 32% year over year. Approved in 8 different indications now.
But the big question for any blockbuster is always the patent cliff. How long does the runway last?
Exactly. And their partner, Sanofi, has hinted they think they have protection out to 2040, but Regeneron isn't just sitting back.
Right. They mentioned a successor on the call, the Super Dupy.
That's right. It's a longer-acting version that's now entering the clinic. And strategically, this is so smart.
They're trying to cannibalize their own product.
Before anyone else can. You kill your own golden goose so you can keep all the gold.
But can they actually improve on an $18 billion drug?
That's the bet. If you can get patients to switch to something that's, say, an injection every 3 months instead of every 2 weeks, you reset the clock. You extend that franchise for another decade.
Okay, so Dupixent is the clear winner. But the other side of the business, eye care, that's a different story.
That is a battlefield. And this is really where the bear case lives, the EYLEA story.
It's a tale of two different products, really.
It is. You have the old legacy EYLEA, the 2-milligram version. Sales there are dropping fast, down 15% just in this quarter.
And that's because of biosimilars, the cheaper generics.
Correct. They are eating away at that market share, but the counterpunch is EYLEA HD, the high-dose version.
The savior.
Hopefully. Sales, there were $506 million, up 18% quarter over quarter, so the strategy's clear. Migrate patients from the old drug to the new patent-protected one.
But there's friction. And the friction seems to come down to something so simple. A prefilled syringe.
It sounds trivial, doesn't it?
Yeah. I mean, why is that such a holdup? Can't the doctors just draw it from a vial?
Well, they can, but you have to think about the workflow in a high-volume retina clinic.
They're just trying to move patients through.
Exactly. They see dozens a day. They don't want to stop, draw from a vial, check for air bubbles, prep a needle. It all adds time.
2 or 3 minutes per patient, probably.
Which adds up over a whole day. They want to grab a prefilled syringe and inject, and EYLEA HD doesn't have that approval yet.
So the doctors are dragging their feet because it's a hassle. Is there a timeline for that?
There is. The FDA decision is expected late April 2026, but there's a wrinkle.
Of course there is.
They're using a new manufacturer for this filing because of some previous regulatory issues at the old facility.
Catalent facility, right?
Exactly. So they're keeping Catalent as a backup, but the primary application relies on a new partner, and that just adds execution risk.
So if that approval slips...
If it slips, the whole unlock for EYLEA HD gets delayed, and every day of delay is another day the biosimilars gain ground.
So April is the big date to watch, the binary event.
That's the bull case. The syringe gets approved, friction goes away, migration accelerates. The bear case is the FDA finds another issue, and the whole franchise just erodes faster.
Okay, so cash cow and Dupixent, a battle in EYLEA. Let's talk about where that $6 billion R&D budget is going, the innovation pipeline.
Right. This is the part of the call where George Yancopoulos, the chief scientific officer, basically teaches a graduate-level biology course.
It's always fascinating, but it's expensive. Let's start with the obesity play. Everyone is chasing this trend. Regeneron's a little late to the party.
They are, but their approach is clever. They're not just trying to make another GLP-1, they're looking at the comorbidities.
The other health problems that come with obesity.
Exactly. So their candidate combines a GLP-1 GIP with a PCSK9 inhibitor.
Okay, for those of us who aren't biochemists, what does a PCSK9 inhibitor do?
It's a protein that regulates cholesterol. So if you inhibit it, you drastically lower LDL, the bad cholesterol. The pitch, which George called a Trojan horse, is just brilliant.
I love that phrase. Explain the logic.
Well, the logic is that patients come for the weight loss. That's the motivation. Vanity, health, whatever. You take the drug to get thin.
The Trojan horse.
But inside that horse, the drug is secretly, aggressively fixing your cardiovascular health. It's lowering your bad cholesterol by 50, maybe 60%.
So you come for the vanity, but you stay for the unclogged arteries.
Precisely. If you can treat obesity and heart disease with one shot, you're not just making people smaller, you're fundamentally changing their entire risk profile. It's a huge value proposition.
A very bold bet. Let's shift to oncology. They dropped a stat about their multiple myeloma drug, linvoseltamab. It almost seemed too good to be true.
The mic drop stat. In an early trial, they achieved 100% MRD negativity.
Okay, explain MRD negativity. Why is that the gold standard?
It stands for minimal residual disease.
Yeah.
It basically means that using the most sensitive tests we have, they could not find a single cancer cell left in the patient's body.
And they hit 100% on that.
100%. Now, we have to put a huge asterisk on this. Small sample size, very early data. But in oncology, you just don't see the number 100% next to MRD negative. It suggests this drug could be best in class.
It really fits their profile. They don't do Me Too drugs. They swing for the fences.
You see that in their gene therapy program, too. They mentioned the DBOTO program, restoring hearing in deaf children.
The Heart and Soul Project.
It is. It's incredible science and great for the image, but from a purely financial view, it's a cost center for now. It's another high-risk, high-reward bet.
Okay, let's pull all this together. What's the so what for an investor looking at this?
The so what is that Regeneron has become a barbell trade. And Wall Street, it doesn't really like that.
A barbell. Explain that.
On one end of the barbell, you have this massive, heavy weight of cash generation from Dupixent. On the other end, you have the decaying lighter business of legacy EYLEA.
And in the middle?
In the middle, weighing the whole thing down, is a $6 billion invoice for that pipeline.
And Wall Street hates investment years.
Hates them. They want margin expansion now. The company's basically telling the street, we're going to ignore short-term pain to build the next 10 years. If you own this stock, you are trusting the scientists, not the accountants.
That's the perfect way to put it. You're betting on the biology lab, not the spreadsheet. Which brings us to my favorite part of the deep dive.
Time to speculate.
It is time for our This Is Not Financial Advice segment.
And let's be very clear. Standard disclaimer. We are not financial advisors. Please do your own due diligence. These are just thought experiments.
Right. We're just spitballing ideas like we're trying to get a bonus. I'll go first. I'm calling my trade the Vanity and Vision long.
Okay, lay out the thesis.
The setup is that the bears are way too focused on the EYLEA decline. They think the franchise is dead. I think they're underestimating the April syringe catalyst.
You think the approval is a bigger deal than the market is pricing in?
I do. The FDA clears it in late April. That workflow friction vanishes. EYLEA HD sales pop in Q2 and Q3, and the shorts get squeezed.
And the vision part.
That's the kicker. Later in the year, you get positive data from the Trojan horse obesity trial. You prove you can make people skinny and save their hearts. The hype multiple kicks in.
So the trade is just long Regeneron stock.
Long REGN, but I'd hedge it.
Yeah.
I'd short a basket of the pure play biosimilar manufacturers. You bet on the innovator, you bet against the copycats.
I like that. A pair trade. It protects you a bit. My idea is different. It's all about the balance sheet. I call it the cash hoard M&A coil.
The coil.
Think of a spring being compressed. You have $19 billion in liquidity just sitting there. That's capital inefficiency. The market hates it.
So you think the pressure's building?
I think the pressure from the street is going to force their hand. They need to plug that EYLEA revenue gap before the cliff really hits.
You're betting they finally go shopping. They make a big acquisition.
I think they have to. Management used the word opportunistic on the call. So the trade is to buy out-of-the-money calls for late 2026. You're betting on a volatility event. You're betting they announce a mid-sized acquisition.
And the stock rips because the uncertainty around all that cash goes away.
Exactly. The science is great, but the wallet is just too heavy. They have to put it to work.
But that's so against their DNA. They build, they don't buy.
Yeah, it is, which is why the trade uses out-of-the-money calls. It's a contrarian bet. But, with $19 billion burning a hole in your pocket, sometimes pragmatism wins.
Two interesting plays. One bets on internal execution, the other bets on external action.
Both are built on the idea that the company is currently priced for a disaster that probably isn't coming.
So to wrap this all up, Regeneron posts a strong quarter. Dupixent's growth flywheel is spinning faster than ever.
But the friction is real. That $6 billion R&D bill is making investors sweat.
And the whole story for 2026 seems to be about crossing that bridge to EYLEA HD.
If they stumble on that syringe approval in April, the stock is going lower. If they stick the landing, the whole narrative could change.
Which leaves us with a question for you, the listener. Is the market wrong to punish a company for investing billions of dollars in science? Or are they right to demand better profits today?
Do you want the golden egg right now, or do you want to own the goose that's going to lay them for the next 20 years? Regeneron is clearly choosing the goose.
You'll be watching to see if it lays. This was Talk Tickers. Keep your eyes on the tape.